A lot of the US stock market seems to be quite overvalued, so in today's video, I thought I would look at some foreign stocks, specifically a Russian gold mining company, after having a brief look at them in a comparison between some of the largest gold miners that I did just a couple days ago. Go check that out after this video, by the way.
Just note that I had to re-record the stock intro and the section about their mines and assets, since I accidentally broke the upload file even though it looked fine in the editor for Tuesday's video. So the asset-based model and the discounted free cash flow will be compared to numbers from Monday, though the stock intro will have numbers from today, Wednesday. So sorry about that, let's get into the video.
Hey, my name is Tucker Krause, and I'm a 14-year-old investor. In today's video, I'm going to be doing a stock analysis of Polyus Gold. Since they're a foreign stock, I'm likely going to be spending more time than usual introducing the company before I get into the financials. Let me know what you think of that style in the description down below. And so, let's get into a quick stock introduction.
Polyus trades with the ticker symbol PLZL on the Moscow Stock Exchange, and this is as of May 19, 2021. They're trading at, when converted from rubles to US dollars, $215.67 with a market cap of $29.05 billion. They have a PE ratio of 18.13 and a dividend yield of 5.05%.
Polyus Gold is a Russian gold miner and the third largest gold miner globally. They were started in early 2006 as a spin-off of Norilsk Nickel's gold assets, though now they've gotten to the point where they have nearly half the market cap size of Norilsk, despite originally being a spin-off. Polyus also has 104 million ounces of gold in reserve, which is the largest of any publicly traded company.
This isn't Polyus's exact demand, this is just the global gold demand. We can see definitely a bit reliant on jewelry, even with it dropping 34% year on year, likely due to COVID-19, though due to inflation and people buying gold as a hedge and gold price going up in general, it's very likely that the bars and coins and ETF sections are going to move substantially, as well as technology becomes more advanced and widespread. Gold will need to be used in lots of chips and whatnot. Central banks, I'm sure their gold buying depends on the specific policy of each bank, so you probably want to look into each bank more specifically. But then we can see here with the microchip shortage that it fell 7% year on year, though it's likely that's going to reverse in the future. We can see even just by the smaller jump in gold, it still increased by 3% for gold bars and coins. Gold buying by central banks declined sharply, though we can see Russia, the largest gold buyer since 2005, so as Polyus mentions in other areas of the report, their largest sections are probably more so the banks and the bars and coins compared to jewelry, but we can see that it suspended it at the beginning of April, long before price began to ran, so it's possible that as COVID-19 comes to an end, they reverse that, but again, you want to look into their exact policy. But then we can see holdings in the ETFs grew massively as well, so it's likely that jewelry will decline, but bars and coins and ETFs should definitely make up for that.
Polyus does their best to maintain high ESG standards by doing things like supporting the local communities around their mines, building things like sports centers and cinemas, and more recently helping them with the COVID-19 pandemic. And for those who are into that sort of thing, they also attempt to limit greenhouse gases and use more green energy at their mines, as well as limit accidents, injuries, and workplace fatalities, though there still sadly was one fatality in 2020. And they have a no-tolerance policy towards bribery and corruption, and will immediately investigate it following the guidelines of the Russian government, and they have lots of independent directors. Now you might be wondering kind of why I went all over that sort of thing, but just because they are a Russian company, you probably want to be a little bit weary, and so it does seem like Polyus does to an extent pride themselves, because they have a large section in their annual report dedicated to this, on being like a generally decent company. Onto Polyus' mining strategy. All of their mines are fairly low grade in G/T terms, ranging from the high 1s to the mid 3s. For reference, a low quality mine should have a rating between about 1 to 4, and a high quality mine from about 8 to 10. So on the surface this looks pretty bad, but because they use all open pit mines, this has far lower costs, and because they're essentially often will just be blowing up the ground or digging through it with a truck, they have much lower costs and are able to get out way more gold, so this makes makes up for it, allowing them to be in the first decile of lowest cost gold producers.
Alright, so first up, Olympiada. I'm just going to be butchering these names and going over just a couple of their more notable assets, but Olympiada is the largest operating gold mine in Russia and is Polyus's flagship asset. Koronica is notable because it was commissioned in 1965, which makes it a 56-year-old mine. So on one hand, this shows the quality of their assets, or it could also show that this mine is likely to run out soon. We can see the refined gold output still increased in 2020, though something like the grade has gotten lower and is, even before, was quite low. But just for a quick comparison, we can see right here that a typical gold mine operates for 10 to 30 years, so that is quite a lengthy lifespan for a mine. I also just wanted to quickly touch on alluvials, because it's been yielding gold since the mid-1840s as a sand washing operation rather than a full-on mine, and it's the only non-mine that Polyus operates for its gold assets. Or, well, all of them are gold assets since they are a gold miner. And I still, by the way, recommend that you look through these for yourself on their annual report and go more in depth into their assets and that sort of thing. They don't have too many, so you don't gotta worry about looking through 300 things like a royalty company.
They are also analyzing Sukhoi log, probably butchered that pronunciation as well, for if it's worth it to build a mine there and develop it. But I'll get into that a little bit more in depth later in the video, just more around their future plans and whatnot. Also, first off, sorry if the perspective keeps changing throughout the video because the cheap $30 stand I bought for my phone to record these videos is finally starting to give up, but that's not too important. So the growth prospects for the company are, of course, gold price going up, which is very likely going to happen in this highly inflationary environment, and if possible, the ruble going up. But you'd also want to look more into Russia's economy for that. On the surface, their current CPI is higher than the US dollar, so right there doesn't look too great, but at the same time, I feel like Putin would be more willing to pump interest rates across the market, whereas Powell isn't. I don't know, you'd want to look into that a bit more to see if that's a valid growth prospect. Of course, there's also Sukhoi log, and just something massive is that their dividend policy is to pay out 30% of their EBITDA as a dividend. So if their EBITDA starts going up because, say, gold price goes up or Sukhoi log goes up really well, their dividend's also going to skyrocket as well. And so, but lots of people might say in the commodity boom, oh, I want to go buy a gold miner, and then see that this company has such a massive dividend, might shoot the price up even more, but that's just a theoretical guess. For future plans and what they're doing right now, they are drilling more and exploring around their current mines to determine if they can continue to expand their current mines, and as well as they're developing their current mines more, adding more mills, that sort of thing. But of course, as I've teased throughout half this video, Sukhoi log is the main thing they're looking at.
Sukhoi log was originally discovered in the 1960s and was drilled from 1961 to 1993, though no mine was ever fully developed. In 2017, Polyus obtained the license for Sukhoi log, and in 2020 consolidated their ownership of Sukhoi log. They're currently doing feasibility studies and that sort of thing to determine if it's worth it to develop and build a mine here. And they plan to make that investment decision by 2021, though in other areas the document says 2022, so I'm guessing this is referring to late 2021 at the earliest. If they did go through with it, it is going to last roughly 40 years according to them, and it would be an open pit mine like the rest of their mines. But the main notable thing here is why it's so special is that it's the largest gold deposit in all of Russia. So it would generate a ton of cash flow if everything went successfully.
Now, let's quickly hop into their financials.
So I just quickly want to do some of the fill town analysis methods, such as moat management and debt analysis, though I'm not going to be using his intrinsic value calculator since the EPS of this company is kind of wonky, which is a big part of that intrinsic value calculator. And so we can see their moat is very strong since most of them, other than EPS, which again is kind of weird, we can see even in 2015 it was half of this. So very different. But we can see 10% is solid for a moat, and we can see this is of course well above that generally. It would be much more reliable and better if these were all at a consistent rate, but just because they're so high, it almost makes up for that. So that's again one thing to be a little wary of, the massive difference, but still decent. So management analysis, we can see return on invested capital is 40%. So this definitely shows that the management team is effective and know how to grow the company, since over 10% is good, and it's 4 times that. that. Return on invested capital shows that, okay, how well is the management doing with all the money that we're giving them by buying into their company, and we can see they are growing that massively. And consider, again, about 10% is a solid return on equity. Onto debt analysis, we can see that it would only take them 2 years, to get rid of all their long-term debt if they didn't add any and had identical net income and whatnot. Though to be fair, that's likely not going to be the case. But and they're obviously not going to put all of their net income into debt, but it's very possible they could actually have a very small amount of debt or no debt in the future, which is quite impressive for such a asset-intensive company like a mining company. So I just want to quickly focus on the red numbers here on this discounted free cash flow spreadsheet. And so we can see their interest expense, just to see how their debt's been doing over time. Their interest expense has grown by 2.6% over the last 4 years, which compared to net income, it's substantially lower, and regardless, just the number itself is far lower, especially compared to revenue, and we can see this growth rate's also far lower, so that's definitely not bad. Short-term debt looks scary, but because the number is so small, they could get rid of that basically immediately with just some of their cash on hand. And their CAGR for their long-term debt has been slowly decreasing, almost at the same amount that their net income has been increasing, so that's pretty decent there as well. And so we can see that, okay, it is very possible, yeah, these guys have very manageable debt, even though they're, as back in that gold miner comparison, their debt looked really scary. But there's still one more scary debt thing I want to get into. But before we do that, here is their revenue versus the gold price. And we can see it's pretty much identical following the gold price, especially jumping up much more drastically as the gold price has rallied much more since. Now, this is what I mean when their earnings per share is all wonky. You might be, what? So they just were a newer company and they weren't making as much money here. But when you look at the shares outstanding, 3 billion in 2011, 140 million in 2016. And look at that difference. Part of why this broke the CAGR, because the number was so different here between 2020 and 2011, but that's why I think it's probably better to use net income and discounted free cash flow, just because these earnings per share, it's all over the place with this. And this is actually part of why I think that their debt is so high, is due to the fact that they've been switching out equity in the company for bonds. And you can see that in their balance sheet, a substantial portion of their debt is in the bonds that they have issued, not necessarily just in bank loans. So something we can analyze a bit better, we can see net income 2014 still negative, and again we can see 2012, 2015 almost identical, earnings per share completely different. But as we can see, it's definitely been a bit all over the place and isn't really following gold price much at all. So that's definitely a little bit scary, though their CAGR has still been 12.44% on net income, and if things like gold price continue to go, Sukhoi log works out well, they'll probably be able to balance this out. And of course 2020 likely had that larger drop off due to COVID-19 expenses and whatnot, which according to their annual report, they definitely took really seriously. Now onto an asset-based model. This follows that their balance sheet's just frankly not amazing. As we can see, their current value as of May 17th is $207.18, at least when you convert from rubles to US dollars, and then their floor value is 1,000% below that, so really not good. And so again, we can see that that's largely because after you subtract the liabilities, they really don't have a ton left to divide by the shares outstanding, since that they have all those bonds and all that debt. So their income statement better make up for that with the discounted free cash flow. So we can see that these two were from the gold miner video. I added one more here. We can see that the first discounted free cash flow is a 3,000% upside. The cut one has a 400% upside, and the more conservative one has a 141% upside compared to its current value of $207.18 when converted from rubles to USD. Now you might be wondering, wait, why is there such a massive difference here? Well, essentially this I took when projecting out their future revenue, when to get their free cash flow based on that revenue. I took the average net profit margins and the average free cash flow to net profit margins, and for the last couple years, and then for the cut down discounted free cash flow, I did the same thing, but I took the lowest number from each whatever year it was. So I think even if it was 2 different years, if net profit margin was lowest in 2017 and then free cash flow net profit margin was lowest in 2019, I took 2017, 2019, whatever the exact years were. And then here what I did was I used the averages since I think that's more realistic due to the fact that plus those net income margins are likely to increase if gold price continues to move up. But the other thing I did is that the reason part of why these are so high is because the discount rate, the weighted average cost of capital, is so low that causes the value to skyrocket. Whereas here I use just a flat baseline required rate of return of 7.5% compared to a weighted average cost of capital, just to bring down the price into something more conservative. And so me personally, after seeing this, I think this is a much more realistic price here. So even using this number, it still looks really good, assuming you can buy this Russian stock. But if you have like an Interactive Brokers account, that should be no problem. Now, let's get to the outro.
So all in all, Polyus certainly looks pretty good, and at this point I'm not able to buy Russian stocks, but as soon as I can, if I'm able to do it in the near future and gold hasn't gone crazy by then, hopefully I can go and purchase Polyus, though because their share price is so expensive, probably not gonna be able to get too much, but that's just my personal opinion. So before we exit this video, make sure to smash that like button once again and leave your comments in the comment section down below if there's maybe another company you want me to look at. Also, something else, security analysis and intelligent investor arrived on Monday, so there won't be a stock analysis on Thursday. Sorry about that. Thanks for watching. I'll see you next time.